We're just moments away from the closing bell. 6 minutes, 5.5 to be exact, as rate hike fears ease. The markets are rallying higher. I would argue that we have the TPP trade deal that's looking rather like a go thing. And then we have a good move in Europe. The European stocks jump. So let's bring in Jim Frischling, NewOak Capital President, and Barron's Senior Editor Jack Howe. Make our viewers some money in these last 5 minutes. Jim, why this big rally? I named a couple of reasons, but that's 500 points cumulative over the past two sessions.
Look, I think twofold. One is we've tested the August lows, and I think the market handled it very well. It wasn't a panic. There was a pullback. We're starting the last quarter of the year. I also think the disappointing jobs number, and I was wrong in my expectation for that jobs number, but I have to tell you, a lot of guys I'm speaking to think it puts the Fed to bed. It's removed an issue of uncertainty we talked about last week.
But the markets jumped, the markets tanked, Jack, when the Fed didn't move in September. So which is it? I don't know if this is the real reason.
Yeah, there's not a good explanation for this buying right now. The market is not particularly cheap. The fact that the Fed is less likely to raise is because the economy looks weaker. That's not good news to me. The only thing that I see here that I like is that some of the money that investors are putting into this market, they're putting it into the right stocks. They're putting it into the beaten down stocks. The ones that are, where the businesses are performing pretty well, the shares have gotten hurt instead of the darling stocks. When I see like a Micron Technology, memory maker, this is a market where we used to have more than a dozen players. Now we've got 3 today. And yeah, earnings are depressed, but they're solidly positive. The company's going to earn $1.50. At the low, the next peak, this company could earn close to $5 a share, and you're buying it at less than 4 times what the next peak likely is. So it's a deeply depressed stock. It's up, last I saw, close to 10%.
You are so right. You know, it's so interesting. I'm looking at the S&P leaders here. You've got Transocean, which was heavily beaten down. Rig, it's up about 8%. You've got Alcoa is looking very good. You've got all kinds of names here. Chesapeake Energy, the energy names are moving along. Joy Global. So, Jim, where would you be putting the money right now?
And look, I can't speak for other companies, but I'm sure they're all renewing their own health care and their benefits plans. And let me tell you something, the prices jump considerably. I'm not talking biotechs. I'm talking health care, the Affordable Care Act, more people being insured, and an industry that's consolidated. So to me, the healthcare sector continues to be a place where I think they have pricing power over their customers, and it's a benefit. It's not great for me, the customer, but it is great for them.
We cannot ignore General Electric. It is jumping 5.5% on news that Nelson Peltz is tinkering. Well, he's putting his fingers in the soup.
We could ignore General Electric. Investors have for years. However,
exactly.
However, I don't want to be just the latest person to say this, but the company really is set up for higher earnings. There's good visibility here. Earnings are depressed on several fronts, including the oil and gas. The business has been de-risked because the capital portion of it, the GE capital portion, is a much smaller contributor to earnings right now. So I think you have a pretty clear path to, let's call it, mid to high teens earnings growth over the next few years. And I think the stock deserves to be. Also, you get a 4% yield, by the way, not bad.
A lot of our investors are in treasuries. I have so many of them constantly asking me, should I stay in treasuries? Friday, we saw a very interesting move. Friday, the yield fell. It touched 1.9%. That's the lowest since April. Today, we have that treasury yield for the 10-year at about 2+. Jim, money in treasuries? Are you sleeping? Are you bored?
I don't think that's where I would leave my money. And in fact, the reason why I feel stocks are the U.S. stocks and domestic plays, and Jack mentioned the dividend you get for GE, we're going to be in a low interest rate environment. You may as well shift to U.S.-centric, domestic plays, service providers, financials, and look for dividends. That's where you're going to get paid. Don't leave your money in U.S. treasuries.
Boston's Eric Rosengren of the Boston Fed told Peter Barnes on Friday, he said, you know what, and it was an exclusive interview, he said this year we will see those rate hikes. Then the ugly jobs report number came out, Jack, and guess what? Today he's talking to Reuters and he says still this year. He expects a rate tightening this year.
Yeah, I would not be surprised. Like, the Fed has signaled so much that the rate hikes are coming. Maybe they'll feel locked into it, and maybe they'll do something that's kind of a hike without being a hike. Like, right now we're 0 to 25 basis points. Maybe they'll just call it 25 basis points, take away the 0, and then call that a hike or something like that. I mean, you can do something without really doing something, but I would not expect any kind of dramatic move from the Fed this year, given the numbers we've seen recently. And I think that doesn't make now a great time, certainly, to go into bonds because the yields are lousy. But as Jim says, some of these dividend yields out there really snuck up on you if you haven't been watching. You can get the 3-4% yields right now.
Great to see you both. Thank you so much. Jack, Jim, it's a pleasure. Jack, Jim, thank you so much.